Welcome to Petros Family Tax. Today we're going to cover a less talked about tax called IRMAA, which is essentially the amount of premiums that you pay on your Medicare Part B and your Medicare Part D in retirement. So this impacts folks over age 65, and it is a little more complex, and so that's why we don't tend to see a whole lot of folks talking about it. So what we're going to cover today is, what it is, what the rates are for the next few years, and some tax planning strategies to mitigate these additional taxes, and then also share a one-time option that's typically available for folks maybe just heading into retirement here. So what is IRMAA tax? It is the income-related monthly adjustment amount. Basically, it impacts your Medicare Part B and D premiums, and it uses the income that you had in one given year, so let's say 2026, and it impacts your Medicare premiums 2 years later in 2028. The other reason why it's a little more complex, a little different compared to the other tax brackets, is that this one is more of a cliff tax. So the traditional income brackets, it's a progressive tax system so that any additional dollar is taxed at maybe that higher rate, but the dollars in the lower brackets, that tax, there's no impact here. For IRMAA, as soon as you're a dollar into that next higher bracket, that impacts you 2 years later. So it's more of a cliff or a landmine that we want to avoid and plan around. The other complex piece is that IRMAA is based on what's called your modified adjusted gross income. In layman's terms, it's essentially like all of your income, whether it's tax-free income, and it does not include some of your standard deductions as an example. So it's all your income kind of bunched together, IRA distributions, capital gains, interest, and municipal bond income as well. And so let's take a look at some of what the brackets are and just talk through some of the nuances and how it impacts you and your Medicare premiums. So these are the projected amounts for 2026 that are going to impact you for 2028. And one of the things you'll see here on the left-hand side when you look at it is individual and married couples. One difference between this tax rate versus some of the other tax brackets is that this one essentially is a doubling of the income. So for that first layer, it's $109,000, but then for that married folks, it's $218,000. You might have heard of what's called a widow's tax, where after the first passing, let's say typically the guy, the widow, even though the income may have dropped and the expense needs may have dropped, it typically hasn't dropped by half. And so we have to watch out for is when we're planning for the longer term, is if we lose a spouse, the increase in Medicare premiums might impact the widow here. The other thing to note when considering IRMAA taxes is that, again, that cliff, where if you're a dollar over, then you're going to be jumping into that higher bracket. And as we can see here, let's say we have a married couple and they're in that first bracket, they'll typically be paying $185 a month per person. But if you're in that second bracket, it's an increase of another $74 for Part B, and then another $13 and change for Part D. And again, that's per month per person. So if we're accidentally over into that second bracket by, again, $1, that might increase essentially your Medicare tax or premiums that you have to pay by about $2,800. So for a dollar over, that's going to impact your Medicare premiums that you pay 2 years later and increase your taxes essentially by almost $2,100 for the full year. Then as you go on, into the higher and higher brackets, that additional Medicare premiums start to increase substantially. Let's compare this to the traditional tax bracket and then come back to this one. When we typically start working with clients, we want to look at the last few years' tax returns for a number of reasons, but one of them, particularly if they're retired, is to identify which IRMAA tax bracket they have been in and try to help them understand where they will be. If they're working with a financial advisor, they might be looking at their tax situation and see that they're in the 22% bracket and they have lots of cushion here in that 22% bracket. But if we look back at the IRMAA tax bracket, they've filled up part of that second level, but they might be pretty darn close to that third level. And so what we want to do is, through our tax projection and advice, is work with their financial advisor or introduce them to the Petros Family Wealth Advisor to have that integrated, comprehensive wealth and tax planning. What we want to do is we want to try to prevent accidentally getting up to that third level. And if we did that by accident, even by $1, that could increase their Medicare premiums by an additional $2,600 or $2,700 per year, several years out. So one of the ways we can try to mitigate this is try to, again, ride that wave in that lower bracket. However, through our tax planning and projections and working with a financial advisor, we want to try to also identify, hey, maybe let's try to rip the Band-Aid off on certain capital gains or IRA distributions, so that way it can hopefully prevent us getting up into that third bracket, and maybe potentially lumping and clumping taxable events in a given year to prevent for the next 2 or 3 years getting up into that third bracket again. And so that's why it's important to not only consider the traditional tax brackets, but also take a look at those RMDs that are increasing each year, and taking into account any market growth and the overall portfolio. So that way we don't accidentally, by selling a great stock, accidentally get us in that third level. The last thing I want to talk about is a one-time adjustment. So this is particularly good for folks that are just about to head into retirement. So again, just to kind of reiterate that on that IRMAA, the income that you have this year is what's going to impact your premiums 2 years from now. And so when somebody retires, there's a form called the SSA 44 that allows for some life changes to potentially adjust your Medicare premiums immediately. And so one of those cases is what's called a work stoppage or a retirement. So let's say, for example, this client is in the higher bracket and they got 1 year left to go before they retire. What we can do is, in that year of retirement, they might have been in that third level based on their modified adjusted gross income. But then we're projecting out, for the remainder of their retirement, that they're going to be in the second or the first level. And what we can do is we can fill out this form, send it over to the Social Security office, and say, hey, we have a work stoppage or a retirement. We're going to have this reduced income. Please go ahead and adjust our IRMAA rate or IRMAA additional premiums to what we anticipate income tax bracket to be. And essentially, it saves the client 2 years worth of that additional IRMAA tax. So hope you found that helpful. And again, if you did, please go ahead and subscribe, and hit that notification button. Thanks so much for your time today.